A lot of investors ask me, should I use a conventional loan or a DSCR loan on my next refinance or purchase? In this video, I'm going to break down when to use each one, who they are actually for, and how to know when each one is good for you on your next deal. If you don't know me, my name is James Miller. I've closed hundreds of loans all over the country with investors, and the whole reason I started this channel was to educate people like yourself on how to grow their portfolio and play the game of Monopoly. So first, let's talk about how these loans are actually different. I think a lot of investors get confused or don't truly understand what sets them apart. The first key fundamental difference is how you qualify, and I'm specifically talking about the income. With a conventional loan, you qualify based on your personal tax returns, or you're going to qualify based on your W-2 and pay stubs. While the DSCR loans, you qualify based on the rental income of the property, meaning as long as the rent is high enough to cover the principal, interest, taxes, and insurance, and sometimes HOA, then the lender will go ahead and do the loan. The other key difference is going to be how you can close title, or what I mean by that is what's going to be on the deed of the loan. So in a conventional loan, you are required to close in your personal name, whereas in a DSCR loan, you can actually close in an LLC. If you close in an LLC, it's considered a business purpose loan, and typically what that means is when somebody looks up your property online, they will see the name of your LLC on title. However, once again, your credit score and you will still be responsible for making that payment as a representative from your LLC. One other major key difference with them is that conventional loans do not have a prepayment penalty, meaning that as soon as you want to refinance, pay off, or sell the property, there's no negative impact for you at all on a conventional loan. However, on DSCR loans, there typically is a standard of having at least a 3-year prepayment penalty. You can extend that thing out to 5 years, or you can, a lot of times I have clients go down to 1 year. The lenders are essentially trading off the fact that they're not going to be collecting your tax returns, they're not going to be collecting any personal income docs, and so because they're kind of in the dark about your full financial situation, their trade-off is, hey, just let us hold on to this loan for 1, 3, 5 years. So when it comes to these key differences, I think this typically will benefit the DSCR loans. Income in general, whether you make a lot of money or very little money, the debt to income ratio becomes a problem for investors, especially ones who are investors who are self-employed. The reason why is because when we're going through the process of looking at your tax returns, a lot of people are doing their best to write off as much as possible. And the more you write off, the lower your income looks like on your tax returns, the harder it is to qualify with a conventional loan. At the end of the day, they're looking at what's called a debt to income ratio, and you need to be below 50% on that debt to income ratio. Well, if you're having all these investment properties, it can negatively impact that debt to income ratio as well, because typically people are utilizing those investment properties as write-offs, and those properties become a loss on their personal tax returns. Whereas a DSCR loan doesn't have that problem at all. The other thing too is you can qualify based on your credit score. On a conventional loan, if it's you and a partner, they will take the lower credit score of the two. I have so many clients where they have a 500 credit score and they have a partner who has a 700 credit score. We can go off that higher person's number. Or we can add somebody to an LLC. We can make some changes to how it's structured on title before we go to make the move. And so there's all these different advantages in the flexibility of the DSCR loan. So a lot of times if your financial situation isn't perfect, DSCR loans are going to help you, and that's where you just got to speak with a professional like me to figure out how we can structure it the right way and put you with the right lender to make sure we get you to the finish line. Now, there's a couple other key things that DSCR loans are different than a conventional loan in the fact that they care about your payment history, because they don't look at your tax returns, they don't know your full financial situation. They need to make sure that, hey, okay, well, we can prove that the rent's enough to cover the payment, but we also need to make sure that this person's actually good about paying their bills on time. You can have up to 1 30-day late payment over the last 12 months, then you are good. If you have more than that, the lenders will not do the loan. You basically proven, they're like giving you like one oopsies, so to speak, but beyond that, they think it's a consistent habit, and thus you are a high risk. The last key difference is the number of properties that the lenders allow you to have. On a conventional loan, the government only allows you to have 10 conventional loans. Now, to be fair, most people run into the debt to income ratio problem before they get to 10. Like I have most of my clients that they're having investment properties, they run into the DTI problem at like 2, 3, 4, 5. Like they don't get to 10. But if you're one of those people who has a very high income earner, and then you can get to 10 properties, you're eventually going to run into the limit. And versus DSCR, there are no limits. you literally could have 1 property or 50 properties. They will allow you to continue to go. So now that you understand the key differences, let's talk about when you should use each one. For conventional loans, it makes sense for investors who make a lot of money. You're a high income earner, the debt to income ratio is not going to be a problem. You're comfortable, and this is probably the most important thing, that you're comfortable with providing all these income docs. Sometimes people have easier financial situations, more specifically somebody who maybe is a W-2 employee, their tax returns aren't as complicated. Once you become self-employed, this thing becomes very convoluted because of all the write-offs. But either way, it's for the person who's okay and actually knows that they can qualify under the debt to income ratio of 50%. I would also say it's really good for people who are adamant that they do not want a prepayment penalty. We have a simple answer: conventional loan all day, every day. You're comfortable closing in your own personal name, conventional loan is totally fine as well. And in certain circumstances, conventional loan might be the better option for somebody who wants our lowest interest rate possible. The reality is when it comes to DSCR versus conventional, the rates are actually very comparable when it comes to a 3-year prepayment penalty on the DSCR loan. As I run these numbers on a daily basis, sometimes conventional loans are better rates, sometimes DSCR loans come with better rates. It just depends on the person's credit score, the leverage, all the different factors that go into it. But on average, the conventional loans do have a little bit better on the interest rates. And lastly, if you're somebody who's looking to get into like a 15-year note, the conventional loans typically will have better rates on the 15-year note than the DSCR loans. A lot of times DSCR loans don't even offer 15-year notes, or if they do, the rates don't change. As for the DSCR loans, they're perfect for investors who do not want to go down the rabbit hole of their income. They do not want to pull all their income docs, whether that's retirement docs, personal income docs, tax returns, you name it. I say they really are perfect for anybody who has a lower income that can't qualify on the debt to income ratio, maybe a high income earner who has a lot of debt, or somebody who has a lot of write-offs in terms of they already own a bunch of investment properties and so the debt to income ratio is going to be a little bit flawed, or definitely somebody who's self-employed. Somebody who's self-employed, you're going to have a hard time qualifying for these investment properties. If you're getting multiple investment properties, not only are you taking the tax losses typically on those investment properties, but you're typically also showing on your tax returns a lot lower of an income than you're actually making because of the benefit of owning your business. So typically it's for people who are just wanting to get in there and look at, hey, the simple math, is the rent enough to cover the payment? The lender will do the loan. They love that. It's also for people, obviously, based on what we talked about earlier, who make their mortgage payments on time. If you're somebody who's missed mortgage payments or made multiple 30-day lates in the last 12 months, obviously that's not gonna work. And the great thing about the DSCR loans is that obviously a lot of times we're gonna try to qualify based on the rental income of the property, but the way that they figure that out is in one of two ways. They either go off of the lease or they go off of what's called the 1007. The 1007 is done on the appraisal. Not only do we get the value of the appraisal through something called a 1004, but we get the 1007, which allows us to figure out what the market rent is. And if the market rent shows enough to cover the payment, the lender will do the loan. So they won't even need a lease or look at the lease or care about the lease whatsoever. However, if we are looking at the market rent comes in low, which does happen from time to time, and our investor has a lease that's higher than that and they're collecting more than the market rent, let's just give you an example. Let's say the market rent's $2,500 a month, but the lease is $2,900 a month. We can go and show proof of deposits through bank statements, typically 2 to 3 months depending on the lender, to show that the investor has been receiving that $2,900 a month in rent for the last 2 to 3 months, and thus the lender will know, okay, we're gonna use that higher amount. And the trade-offs for these loans would be, on a conventional loan, you have to be able to provide all the income docs. We have to figure out if we're able to qualify you based on that 50% debt to income ratio, and then we're gonna have to go through the tedious process of collecting a lot more documentation for the conventional loan. However, if you can do that, then that's great. You won't have a prepayment penalty. Most often your costs are gonna be a little bit less and the rates on average are gonna be a little bit less. On the flip side of the DSCR loan, you're gonna have a 3-year prepayment penalty on average. However, you're not gonna have to provide all the income docs and you're gonna be able to close in an LLC. It won't show up on your personal credit report. We have some flexibility in qualifying you based on a higher credit score or being able to make some moves to make sure you can actually get it to the finish line. So we went over when each one of these makes sense, but how do you figure out what makes sense for your specific situation? That brings us to section 3. Here are a couple of questions that I ask clients when I'm on the phone with them to help the two of us decide what option or what best direction fits for them. The first one is, how do you generate your income? Are you somebody who writes off a lot? Do you make a bunch of money? Do you not make make a bunch of money, but you don't have any debt. I'm just at the end of the day thinking about the debt to income ratio problem. We need to be below 50% without pulling your credit, right? Some lenders try to go and have you pull your credit right away. That's their own process. I really don't believe in that. I'm going to trust in you. We're going to build this relationship together. You need to be able to be upfront with me. Of course, once we start digging into it and we verify before we go to submit the loan, we'll double check these numbers. But at the end of the day, you have to be honest with the person up front. So if in your situation, if you know you have a ton of debt or you don't make enough income and you might run into a DTI problem, you need to express that to myself or anybody else who you're working with involving the loan. The next question that I ask is that how much income that they make, right? And then we ask, do you have a lot of debt? Do you have credit card? The main debts that the lenders look at when it comes to the debt to income ratio problem is going to be mortgages, personal loans, could be like something that you got from a local bank. It could be credit cards or student loan debt. Those are the main ones that we have, right? And once we get past that and we know, okay, they don't have a lot of debt, or they do have a lot of debt, this could dictate, should we go the conventional route or should we go DSCR? We then dive into the property itself. If we're doing obviously a refinance or even on a purchase for that matter, we're going to try to figure out what the market rent of that property is going to be. I'm going to ask them, hey, what do you think that market rent could be? And then we're going to start figuring out from there, okay, based on the market rent, based on the loan amount that we're going to have, based on where the projected interest rate is, based on their credit score, a lot of base, right? Then this is all going to dictate what the payment's going to be, so we can start figuring out, the DSCR ratio. Does it qualify? Does the rent cover the payment? The last part of it in terms of DSCR stuff I look at is, what are the taxes, insurance, and is there an HOA? Once I have that kind of information, I can then go ahead and provide them the options that are available to them, both on the conventional and the DSCR side. Sometimes when it comes to conventional versus DSCR, it might make way more sense to do the DSCR loan in terms of the framework and how easy it is to get the loan done versus the conventional. But then sometimes people see the numbers for the conventional and they say, you know what, I don't care how much pain I'm gonna go through. I want those terms. I'd rather have no prepayment penalty. Maybe the costs are a little bit less. I'd rather go that route. And there are times where certain clients will qualify for one or not the other. Kind of crazy, right? Like it's kind of hard to think about somebody who can qualify on the conventional side, but then they can't qualify on the DSCR side. But in certain markets, it could be here in Miami, it could be in California, Washington, some areas that have high values, meaning high loan amounts, the DSCR ratio is just not going to work. The rent is not going to be enough to cover that payment. So in those cases, sometimes the conventional route would be a better option for that client. Most of the time though, it's the flipped. A lot of times people don't qualify on the conventional side and they do qualify for the DSCR. One thing to mention is that you can mix and match at the end of the day with conventional versus DSCR. Your whole portfolio doesn't have to be conventional loans. Your whole portfolio doesn't have to be DSCR loans. If you have the ability to qualify for both, then you can utilize each one of them as you so choose. Now, from my experience, it doesn't really happen. Most of the time, when somebody converts and goes over to DSCR loans, it's like kind of go into the dark side. They never go back, because at the end of the day, once you have that experience of doing a DSCR loan and you get into the rhythm of it and you understand what the lenders are expecting and you've done a couple of those loans, it's just rinse and repeat, go. So there you have it, DSCR loans versus conventional loans. I might be a little bit biased. I'll do conventional loans all day, but who doesn't love a good DSCR loan? But the truth is there is no best loan. There's a best loan for you and your situation. If you want to get your next deal structured and funded, the market is starting to improve. This is the time to start thinking about making that next move. So click on the link below. Let's talk about what works best for you. Thank you for watching. Check out this video over here where I talk about why a lot of investors are moving over to DSCR loans.